Another reason people, I think, are naturally but not appropriately scared of putting less than 20 down is because they have this fear of private mortgage insurance. As if private mortgage insurance should get a black eye. I'm the rare swimming against the current on this one. But I don't see anything wrong with private mortgage insurance. The reasons are private mortgage insurance goes away in 2 or 3 years. It's something that will actually help you get the house. So if the issue is you can buy the house and pay PMI for a couple of years, or you don't buy the house, this is a choice any individual would make to prioritize how important is it to have this home, and if it costs you a little bit different than you expected, you don't have to buy the home. PMI also is an advantage even if you could afford to put 20 or 30% down, because PMI allows you to put 5 or maybe 10% down. And the key thing here is what else can you do with the cash you're not putting into your down payment? You have it for use for other investments. You have it for use to put in the stock market or your 401k or your any place else you want to use it. You have access to the cash. So if the cost of keeping cash is paying a little bit of PMI, again, I can lay out the numbers quantitatively and show you how each decision tree, I can show you the limb of each part of the decision tree and show you the numbers, and then you choose which one makes sense for you. Another benefit of the PMI, and this is something you'd have to confirm with your tax preparer, whether it's a CPA or H&R or anybody in between, PMI is tax deductible. So it's the cost of having PMI isn't even as bad as people think, and if it's temporary, I don't see why it should get a black eye. After the mortgage meltdown, interest-only loans have this huge, several black eyes. ARMs, which are adjustable rate mortgages, are also considered by many people to be scary loans, because people used those back in 2006 and 2007, and look what happened to the country. There's nothing wrong with any of these loans. They're just tools. They're products. If you understand how they work, you understand what the tool can do for you in your circumstances. Maybe you're only going to be in the house for 4 or 5 years. Maybe you just want to know that you'd rather have a lower payment because the cash you're not putting in you can use for other purposes. I've spoken at law firms and businesses, to the faculty of colleges and universities about how mortgages work. One of my skill sets is I'm very quantitative. I've developed graphs and charts which help people just visualize how it all works. I've got an MBA from NYU. I did an advanced year at Wharton Graduate School of Business. I know the numbers. What I don't do is make decisions for you, but I will show you how these things work, because ultimately the decision isn't always financial. It doesn't matter if A, B, C, and X, Y, and Z say this is the best financial decision for you. What matters is how you feel about it, which one makes you most comfortable. A quick example, if you are buying a house that you know you're not going to be in for more than 5 years, absolutely. Family's getting married, you've got a new job coming up, you want to be able to upgrade to a better house. The right loan for you is probably an adjustable rate mortgage, where the rate is fixed for a certain number of years, then it can change. Well, if you're only going to be there for a couple of years, you don't care what happens when it changes. It's not going to affect you. It can't affect you. Nonetheless, for many people, a better choice loan would be the 30-year fixed rate. It's going to be at a higher interest rate, which means you will pay more total dollars per month, and you will pay more interest per month. However, what you're getting for that extra payment is peace of mind. This is a loan that if your decisions change in years from now, you're safe. This is a loan that you're not going to be looking over your shoulder every day worrying about what's happening in the Middle East or the White House or the climate, the economy, the Federal Reserve rate, nothing. Nothing is going to affect that loan. It's a 30-year contract. That is worth something. And again, with the numbers, I can help you evaluate, is it worth a little bit of paying a little bit extra for the fixed rate than it is for the ARM, the adjustable rate mortgage? Is it worth paying a little bit more to get that peace of mind? And for many, many people, it absolutely is. That would be the right decision. My goal is just to show you how this all works so you can make an informed decision.